Good day to Madam Rauda. I'm Vinisha Sarunan. Now let's begin with a quick look at the history of Pintras Jaya Berhad. So the company was founded in 1989 as Pintras Jaya Sendirian Berhad, focusing on foundation engineering. But just in 2 years, in 1991, they went public and adopted their current name as Pintras Jaya Berhad. By 1994, the company was already listed in the main board of Bursa Malaysia, solidifying their position in the market. In 2003, they expanded their portfolio by venturing into the manufacturing of metal products. Then in 2011, Pintras also furthered themselves into property development, covering both residential and commercial products. Today, Pintras Jaya Berhad stands as a leading player in foundation engineering, civil works, manufacturing, and also property development. So now let's explore on what is Pintras Jaya Berhad is all about. So it is recognized as a leading foundation and civil engineering specialist in Malaysia. Their core services is including board piling, earth retaining systems, substructures, and also basement works. So what sets Pintras apart is their technical excellence, timely project delivery, and also strong safety standards. They have earned a solid reputation to successful projects in government and also private sectors. So their headquarters is located in Shah Alam Selangor. Pintras Jaya Berhad is also stays true to their vision and mission. So their vision and mission is to be trusted and a leading engineering and construction company in Malaysia and beyond. They also aim to deliver high quality, innovative and sustainable solution, all while upholding ethical standards, ensuring safety and focusing on environmental responsibility. Finally, let's take a look at Pintras Jaya Berhad's business landscape. Their core business activities revolve around heavy civil engineering, particularly foundation works and also piling. The company has subsidiaries supporting various aspects of construction and also property development, further strengthening their presence and capabilities. So as for competitors, Pintras operates in a competitive landscape alongside with other major construction and engineering firms such as IJM Berhad or Gamuda Berhad. So together, these elements showcase Pintras Jaya's position and influence in Malaysia's construction and engineering sector.
So, in total, we have already discussed that there was a large kind of business activities IGM Corporation is known for its subsidiaries, and now I would like to talk about its competitors. So firstly, one of the competitors is Gamuda, which is also based in Malaysia and a leading engineering and construction and infrastructure company for known delivering innovative and sustainable solutions. It's almost the same with IGM Corporation as the PhD, that's why it can be considered as one of the main competitors. And the second one, as it mentioned on the slide, it's a UEN Group Berhad, is fully owned subsidiary of Khazanah National Berhad, and that's one of the Malaysia's one of the leading engineering-based infrastructure company and a group. So it's also competes with IGM Infrastructure, Engineering, and Township Development. So they have like similar sectors like government or private, doesn't matter. You can work on both. And the next one is YTL Corporation Berhad, which was founded in 1955. So it's also one of the Malaysia's largest and most diversified conglomerates, and the company also operates in multiple sectors like private or non-private sectors. Thank you. So in the next slide, we will talk about its, in general, what kind of activity IGM Corporation is also popular with, its vision and mission. So about the company, it's a major player, like currently in construction, property development, industry, infrastructure, concession, and foundations. And it operates in Malaysia and overseas markets like India, China, and Indonesia. It's also known for a known delivery of large-scale infrastructure and commercial projects. And its office located in Kuala Lumpur, Malaysia. Its vision for the company is to be leading Malaysian conglomerate admired for its excellence, quality, and performance. And the mission is to deliver sustainable value to stakeholders, commit quality innovation and operational excellence, foster a safe, rewarding environment for employees, and conduct business with integrity, professionalism, social responsibility. Hi, my name is Samandar Bekir Uldashov, and I'm here to tell about company history of IGM Corporation Berhad. So, IGM Corporation Berhad was founded in 1983 through the merger of three civil engineering companies, ISB Construction SDN BHT, Jurtama SDN BHT, and Mudajaya SDN BHT. So, this strategic merger was aiming at creating a formidable entity capable of competing in Malaysia's rapidly expanding construction market, which was seeing an influx of international companies. Next one, and by the late of 1980s, the company rebranded as IGM Corporation Berhad, signaling its growing stature. In the 1990s, so the company diversified its operations, expanding into industries such as palm oil, property development, and infrastructure. It also expanded into new regions, taking more projects on South Asia, Africa, and South America. In the 20s, IGM solidified as its position of Malaysia's largest and most diversified conglomerates, with acquisitions such as World Building Group in 2008. So in recent years, IGM has shifted focus toward sustainability and technological innovation. The company has embraced digital transformation, including Industry 4.0. Initiatives to streamline its operation and enhance efficiency.
Hi, my name is Tanindra Sivaraja. Today I'll be presenting a financial SWOT analysis of two prominent construction companies in Malaysia, Pinteras Jaya Berhad and IGM Corporation Sdn Berhad. I'll be highlighting their financial strengths, weakness, opportunity and threats based on recent performance and market conditions. Pinteras Jaya Berhad is known for its strength in foundation, geotechnical engineering, giving it a competitive edge in specialized construction projects. The company also owns modern, specialized machinery which helps reduce costs by minimizing reliance on rented equipment. These factors contribute to operational efficiency and financial stability. So, however, Pinteras faces some weaknesses. Its income is largely project-based, meaning delays on cancellations can affect revenue. Also, its operations are mainly focused in Malaysia and Singapore. This limited regional presence makes the company more vulnerable to local economic conditions and restricts its chances of expanding globally. In terms of opportunities, the growing demand for infrastructure and government-backed development projects creates a strong market for growth. There is also increasing interest in green and sustainable construction, which Pinteras can also explore to stay relevant and competitive in the evolving industry. On the other hand, threats such as rising prices of construction materials, stiff competition, and regulatory delays can slow down projects and disrupt cash flow. These risks need to manage carefully to maintain stability in the long run. IGM Corporation Sdn Berhad has multiple financial strengths. It is a diversified company with operations in construction, property development, infrastructure, and plantations. This allowed it to balance financial risk across different sectors. IGM has also has a strong presence in several international markets, such as India and Indonesia, giving it access to wider opportunities and reducing dependence on Malaysia's economy. So, however, IGM faces some challenges. Managing such a diverse portfolio can be complex and may strain resources. Furthermore, even though the company is multinational, a large portion of its projects still depend on government and contracts in Malaysia. This reliance on public sector work can be risky if there are political and budgetary changes that delay funding. In terms of opportunities, IJM can advantage of large-scale infrastructure initiatives and public-private partnership projects. It presents in emerging markets, offers growth potential, so especially in areas with rising construction and demand. At the same time, the company must manage external threats such as currency exchange and fluctuations, and especially when dealing with international revenues and political instability in the regions where it operates. Like Pinterest Jaya, IJM also faces strong competition in the industry, both locally and globally.
Hi everyone, my name is Harini Anadre, and today I'll be presenting a trend analysis of Pinterest Jaya's Berhad's financial performance, focusing on key financial ratios for the years 2023 and 2024. So, let's begin with the liquidity ratios. First and foremost is current ratio. In 2023, the current ratio was higher but slightly decreased in 2024. The small reduction shows the company's short-term liquidity weakened a bit. It likely happened because current liability grew faster than current asset, possibly due to higher accounts payable or short-term borrowings, while cash or inventory levels may have slightly dropped. Then, quick ratio. Quick ratio is actually went from marginally 2022 to 2024. This indicates the company's immediate liquidity executing inventory becomes slightly less. The reason could be a smaller reduction in highly liquid assets such as cash or receivables, or a lower ability to pay debts quickly without selling the inventory. Then asset management ratios. First and foremost is inventory turnover actually improved significantly from 2023 to 2024. This suggests Pinterest Jaya sold inventory fast and managed stock efficiently. The increase might be due to the stronger sales demand, improved production planning, or better inventory control measures, which is help reduce holding the cost. Then, total asset turnover also decreased slightly from 2023 to 2024. In the slide, it also shows that the company generated less revenue per ringgit of assets in 2024. This could be due to the underutilization of some assets, perhaps new investment that have not yet contributed fully to sales, or slower overall sales growth. Then, the average collection periods also increased from 2023 to 2024, showing customers are taking longer time actually to pay their invoice. This might result their relaxed credit policies, extended payment terms to support customers, or slower collection, which can negatively impact the cash flow. Then, receivable turnover also dropped from 2023 to 2024, confirming slower collection of accounts receivable. This decrease reflects less efficient credit management, increasing the risk of delayed payments and possible bad debts, which may require the company to improve its credit control procedures. Next is leverage ratio. First and foremost is debt ratios actually improved significantly from 2023 to 2024, indicating a higher proportion of a company's assets or financed by the debt. This may be due to the new loans or increased short-term borrowings to fund operation or expansion. While still moderate, this means the company faces slightly greater financial risk. Then, time interest earned is from 2023 to 2024 is actually improved, meaning earnings before interest and taxes are increased relative to interest expense. These improvements may be due to the higher operating profits or reduced interest costs, signaling the company's stronger ability to meet the interest payments comfortably. Then profitability ratios. First and foremost, gross profit margin is actually increased from 2023 to 2024, suggesting better control of direct costs or the ability to change higher prices. This means the company earned more profit from each sales ringgit before deducting the operating expenses. Then operating profit margin also declined from 2023 to 2024. This indicates that although gross profit improved, operating expenses such as administration, marketing, project ahead improved, reducing their operating profitability. Then next profit margin is also dropped whenever we look at the graph from the 2023 to 2024. Despite higher gross profit, increased operating expenses, interest, and possibly one-time costs, overall profitability to fail, meaning less net income was generated from each ringgit of sales. Then return on asset, which is also decreased from 2023 to 2024, showing the company's asset generated less net profit. This might be because the lower net income or increased asset base, for example, new investment not yet productive, reflecting less efficient asset utilization. Then return on equity fell from 2023 to 2024, meaning shareholders earn less return on their investment. This is mainly due to decreased net income, signaling the company's reduced ability to generate profit for their equity holders in 2024. And now I'm also presenting a trend analysis of IGM Corporation Sdn Berhad's financial performance, focusing on their key financial ratios for the years of 2023 and 2024. So first and foremost is current ratio. In 2023, the current ratio was strong but slightly decreased in 2024 as well. The small decline shows the company's short-term liquidity weakened a bit. It likely happened because current liability grew faster than current asset, possibly due to the higher accounts payable or short-term borrowings, while cash or inventory levels may be slightly dropped. Then quick ratio was also went down marginally from 2023 to 2024, indicating the company's immediate liquidity excluding inventory becomes slightly less robust. The reason could be a smaller reduction in highly liquid assets such as cash or receivables, or a rise in short-term liability, meaning a slightly lower ability to pay debts quickly without selling any inventory. Then asset management ratio. First and foremost is inventory turnover. In 2023, the inventory turnover was low but improved in 2024. This improvement suggests the company to manage the inventory more efficiently, selling goods faster and reducing the time inventory was held. This could be due to the better sales or improved inventory control. Then total asset turnover is also modest in 2023 but increased in 2024, indicating better utilization of the asset to generate revenue. This improvement may have resulted from the higher sales or more effective use of company's assets. Then average collection period was already quite long in 2023 and increased slightly in 2024. This means it took the company longer to collect payments from the customer, which could strain cash flow. The slight delay might be due to the relaxed credit terms or slower customer payments. Then receivable turnover also decreased slightly from 2023 to 2024, showing that the company collected its receivable less frequent. This aligns with the longer collection periods and suggests that the credit control policies might need tightening to improve the cash inflows. Then is leverage ratio for the IGM. First and foremost is debt ratio. The debt ratio is increased noticeably from 2023 to 2024, meaning the company relied more on debt to finance its asset. This rise in debt could have been to fund expansion or operation but also increase financial risk. Then time interest earned ratio also improved significantly from 2023 to 2024, showing that the company generated much more operating income relative to its interest expenses. This indicates better earnings and stronger ability to meet debt obligation comfortably. So last but not least, for the IGM Corporation, gross profit margin, which was stable but slightly improved from 2023 to 2024. This suggests the company managed production costs well and maintained a good pricing strategies. Then, net profit margin saw a substantial increase from 2023 and 2024, indicating much better overall profitability. This could be better due to cost reduction, higher sales, or improved operational efficiency. Then, operational profit margin also increased notably between 2023 and 2024, reflecting enhanced efficiency in core business operation and better cost control. Then, return on assets increased significantly also from 2023 to 2024, showing that the company generated more profit from its asset base. This reflects improved operational performance and asset utilization. Last but not least is return on equity also improved greatly between 2023 and 2024 as well, indicating that the shareholders receive higher returns that can better profitability and efficient use of equity capital.
In 2023, Pinterest Jaya Berhad recorded a current ratio of 2.69, slightly higher than IGM Corporation 2.47. Both companies had strong liquidity position, meaning they could easily cover their short-term liabilities. However, Pinterest Jaya Berhad had a slight edge in this aspect. Quick ratio. When it comes to quick ratio, Pinterest Jaya again comes out on top with 2.48 compared to 1.08 for IGM Corporation. This shows Pinterest Jaya had a much stronger ability to cover short-term obligation using only its most liquid assets without relying on inventory. IGM quick ratio was still healthy but not as robust. Inventory turnover. Pinterest Jaya had an impressive inventory turnover of 11.92 times, meaning it sold and replaced its inventory nearly 12 times during this year. IGM Corporation, on the other hand, had a turnover only of 0.51 times, indicating slower inventory movement and potential inefficiencies. Total assets turnover. Pinterest Jaya was also more efficient in using its asset to generate revenue with a total asset turnover of 0.60 times, while IGM Corporation only achieved 0.22 times. This suggests Pinterest Jaya managed its asset more effectively. Average collection period. However, IGM Corporation performed better in collecting receivable with an average collection period of 101 days compared to IGM, which is 180 days. This means IGM got paid faster, which is beneficial for cash flow. Receivable turnover ratio. Similarly, IGM Corporation had a receivable turnover of 3.62 times versus 2.02 times for Pinterest Jaya. This confirmed IGM's strength in credit management and faster collections. Debt ratio. In terms of financial leverage, Pinterest Jaya maintained a more conservative position with a debt ratio of 27.34%, while IGM Corporation ratio was 45.3%. This means IGM taking on more debt, which could lead to higher returns but also higher financial risk. Time interest earned. Looking at the ability to cover interest payment, Pinterest Jaya again performed better with a time interest earned ratio of 7.98 times compared to 3.46 times for IGM Corporation. Pinterest Jaya had a stronger earnings relatively to its interest obligation, reflecting to lower financial stress. Gross profit margin. IGM Corporation had a significant lead with a gross profit margin of 25.81%, while Pinterest Jaya only managed 3.30%. This suggests that IGM had better control over its production costs and offered high-value service. Operating profit margin. The same trend continues with operating profit. IGM margin stood at 10.61%, far ahead of Pinterest Jaya with 2.30%, indicating stronger operational efficiency. Net profit margin, finally, IGM recorded a net profit margin of 4.70, while Pinterest Jaya achieved 2.40%. This tells us that IGM was more effective in turning revenue to actual profit after recovering all expenses. Return on asset, let's look at how efficient each company used its asset to generate profit. IGM Corporation posted a return of assets of 1.27%, while Pinterest Jaya came in slightly behind at 0.92%. This suggests IGM made a better use of its total assets in generating earnings. Finally, return on equity. When it comes to rewarding shareholders, IGM again takes a lead with a return on equity of 2.61% compared to Pinterest Jaya, which is 1.42%. This means IGM provide a better return on investment made by its shareholders. Current ratio. In 2024, Pinterest Jaya recorded a current ratio of 2.582, indicating a solid coverage of short-term liabilities with current assets. IGM Corporation followed closely with a ratio of 2.41, still above the benchmark of 2 and reflecting healthy short-term financial stability. Quick ratio, Pinterest Jaya also led in a quick ratio performance at 2.453, showing a stronger liquidity even without relying on inventories. IGM Corporation posted a lower quick ratio of 1.16, which, while acceptable, indicates a tighter liquidity position. In 2024, Pinterest Jaya Berhad demonstrated a superior operational efficiency with an inventory turnover ratio of 17.13 times, far outperforming IGM Corporation of 0.693 times. This showed that Pinterest Jaya moved and sold inventory quickly, while IGM had much slower inventory movement, indicating potential inefficiencies. Similarly, Pinterest Jaya recorded a total assets turnover of 0.554 times compared to IGM of 0.278 times, again showing that Pinterest used its asset more efficiency to generate sales. However, when it comes to receivable management, IGM Corporation led its average collection period of 108 days, much faster than Pinterest Jaya, which is 229 days, and receivable turnover ratio of 3.378 times, over double Pinterest Jaya of 1.596 times. This suggests that IGM collected a payment more quickly and managed its credit more efficiently. Debt ratio. In 2024, Pinterest Jaya Berhad maintained a lower debt ratio of 29%, indicating more conservative financial structure with reduced reliance on borrowed funds. This suggests a lower financial risk. In contrast, IGM Corporation had a higher debt ratio of 45.7%, significantly a greater dependence on debt financing, while introducing a higher financial risk. It also opens up the door for potential higher returns through leverage if managed effectively. Time interest earned. When it comes to ability to meet interest obligation, Pinterest Jaya again showed a stronger performance with a time interest earned ratio of 8.803 times. This means it earns nearly 9 times its interest expense, showcasing robust debt servicing capacity. IGM Corporation, still financially stable and had a time interest earned ratio of 5.157 times, indicating slightly less capacity to absorb interest payment but still within a healthy range. Gross profit margin. In 2024, Pinterest Jaya Berhad reported a gross profit margin of 3.8%, suggesting in margin possible cost pressure. Comparison, IGM Corporation recorded a much stronger margin of 26.2%, reflecting better cost control and pricing power. Operating profit margin. Pinterest Jaya operating margin was 2.9%, indicating lower efficiency in managing operating expenses. Meanwhile, IGM Corporation posted a 16.3% operating margin, showing superior operational performance. Net profit margin. Pinterest Jaya net profit margin stood at 1.33%, pointing to low overall profitability, highlighting a stronger cost management and profit generation. Return on assets. Pinterest Jaya was 0.75%, meaning its asset efficiency in generating profit was limited. IGM Corporation outperformed with the returns of assets of 3.44%, indicating better use of assets and drive profits. Finally, returns on equity, Pinterest Jaya returned only 1.05% on shareholder equity, suggesting weak value creation. In contrast, IGM Corporation delivered 6.49%, reflecting more effective use of equity and generate returns.
In conclusion, the analysis of Pinterest Jaya Berhad highlights a company that operates within a specialized niche, focusing on piling and foundation works. Its strong reputation and expertise in this segment support its competitive advantage in the local market, although its limited international presence and narrow business scope expose it to industry-specific risks. Financially, the company maintains adequate liquidity but operates with narrow working capital margins and lower asset turnover ratios, reflecting a conservative use of assets. Pinterest Jaya adopts a low-leverage financial strategy, carrying minimal debt and maintaining low financial risk. Although its profitability indicators such as net profit margin, return on asset and return on equity are relatively modest, the company prioritizes financial stability and long-term resilience over aggressive growth. Overall, Pinterest Jaya Berhad is more suitable for risk-averse investors who are seeking consistent and stable performance rather than high short-term. In conclusion, the analysis of IGM Corporation Sdn Berhad reveals a well-diversified company operating across multiple sectors, including construction, property development, infrastructure, and manufacturing. Its presence in both local and international markets provides broader revenue streams and better protection against sector-specific downturns and economic fluctuations. The company demonstrates a strong commitment to sustainable development with increasing investment in green technology. Financially, IGM Corporation shows healthy short-term financial strength supported by higher liquidity ratios such as current and quick ratios. Additionally, its higher asset turnover ratios indicate efficient utilization of resources. The company adopts a higher leverage strategy, enabling greater access to funding for growth and investment opportunities. This approach, combined with strong profitability indicators such as net profit margin, return on asset, and return on equity, positions IGM Corporation well for continued expansion, value creation, and long-term success. Overall, IGM Corporation Sdn Berhad appeals to investors who are seeking higher returns, capital growth, and a diversified.
Recommendation for Pinterest Jaya Berhad. To support long-term growth and reliance, Pinterest Jaya Berhad should diversity into sectors like renewable energy and smart city projects to reduce industry reliance and expand revenue streams. Embracing digital tools such as BIM and AI-driven system can boost efficiency, minimize delays, and improve cost control. Additionally, maintaining low debt and enhancing cost management through better procurement, budgeting, and supply chain practice will strengthen financial stability and profitability.
To support the future growth, IGM Corporation should focus on expanding its operations regionally and internationally. Southeast Asia, in particular, offers strong infrastructure demand. By tapping into this market, IGM can reduce reliance on any single country and benefit from more than stable and diverse income sources. So international expansions also exposes the company to new innovations and best practices in construction industry. In addition, IGM should strengthen their commitment to sustainability by adopting green building materials, energy efficient designs, and aiming for green certifications. The company can also position itself as a leader in eco-friendly construction. This will not only meet growing environmental expectations but also enhance its brand reputation and appeal to environmentally conscious clients. So lastly, IGM should continue improving its debt management by refinancing high interest loans and also maintaining strong cash flow. The company can reduce financial risk. This will provide greater flexibility in to invest in future projects, pursue innovation, and expand sustainability over the long term. Thank you.